Delighted to have you here. Thank you for joining us on a day when we just got a great big number out, so we'll talk about that. Welcome.
Thanks so much for having me on again.
Yeah, great to have you here. And we'll invite everyone to send their questions in over the next half hour or so. So let's just go to the story of retail sales, which was down in January. There's some blame being cast on fires because people couldn't shop, which is understandable. What do you make of them?
Yeah, so we did see, I tend to track the US retail sales kind of unadjusted year over year just to smooth out, differences in months. And, what we saw was a 4.2% increase in terms of total retail, excluding gas and autos. And that would have compared to 4.5% in December. But when you look at the 2-year numbers, it decelerated. So we were up 8% in December, and then now we're up 7.3%. In January. So a little bit of slowing and softening. And to be quite frank, it wasn't completely a surprise as we've kind of followed some of the high frequency data that we are able to look at, as well as hear from companies. It did seem that things softened a bit in January.
Was there an impact from tariffs? So this is a discussion that we put into everything, but there are Canadian exporters, for instance, that were just trying to get things out the door before tariffs really took hold, the conversation anyway. Was the consumer worried about that too?
Yeah, it's an excellent question. I think certainly after the US federal election, it did seem that we saw a bit of a pickup or a so-called Trump bump.
Yeah.
And that seemed to manifest especially in certain durables categories, so whether it be furniture or autos, et cetera. And so there was a bit of strength into the end year of 2024, and I think some of that was probably consumers being concerned about the potential for tariffs in 2025 and wanting to purchase some of those goods sooner.
Okay, that's really interesting. So that kind of gets to the today story. We can go back really to COVID, actually, and it's been a bit of a tough sector to see great performance out of. And why is that? We go back to COVID. Why is that been the case for such a long time?
Yeah, I mean, so when we look at US staples, we could see, so one of the things I track is the spread of the S&P 500 staples index relative to the broader market, and we're about 2 standard deviations below in terms of the spread of performance over a 3-year basis. Now, one of the easy things to say to dismiss that is, yeah, but tech has been so strong. So if we go another step and look at the gig sectors over a 3-year period, what you'll see is that staples is actually maybe 4 out of the remaining 10 gig sectors in terms of performance over that period. So, sectors such as consumer discretionary have done better, certainly industrials have done better, certainly communications and energy have done better. So it's still been not a great sector to be exposed to. And then if we extend even to 10 years, it's underperformed the market by over 100% cumulatively. So,
I mean, when things get so bad, sometimes they look quite good. Is there a case for sort of a green shoots moment?
So I do believe that at some point, there's a few pain points here, and I think what we need to do, and what I'm focused on, is tracking those and looking for when the direction of travel starts to change. So, for example, we know the cumulative impact of inflation and what that's meant for consumers. We still see signs of some pockets of inflation even currently. So in the most recent month of the BLS, or Bureau of Labor Statistics, inflation tracking, we saw meats, poultry, dairy, and eggs go up 6% year over year versus 4% previously. So still inflation in eggs and beef, for example. And cocoa is another area. So it being Valentine's Day, probably relevant to mention that companies like Hershey and Mondelez are talking about double-digit inflation in chocolate in 2025. We know about tariffs, which we spoke about already. Immigration is another topic where some of the deportations are resulting in things such as employee absenteeism, which is a pinch on productivity at the retailers, as well as maybe there's a demand side to that. And there's also been a few other areas, such as the trend towards using GLP-1 drugs and ultra-processed foods and consumer concern about that.
That's so interesting.
So there's a few things here that investors are, I think, looking at and trying to look for that, whether that's second derivative or we're going to see some green shoots for things improving in the future to get more interested in U.S. staples.
So a chunk of that sounds like it is just getting some certainty, getting the clarity, some of that.
Yes.
And then some of it's more secular, I guess. The GLP-1 stuff sounds much more secular. Just take us there, because that was all anyone talked about a couple of years ago, and it has a lot of great things that seem to have come out of it. The valuation story for those is a little bit different now. How is it coming into the retailers? It was always suspected that it would.
Yeah, so what's interesting for me is many of the companies are still saying, as far as GLP-1 in particular, that they're not able to visibly observe a demand impact, but we do know that for retailers that have pharmacy operations, that those in general, we're seeing pharmacy up high single digit to double digits. And so we know that consumers are going there and getting the scripts to use the GLP-1 drug, so that's helping the top line, but it's a lower margin business. But at the same time, there have been independent studies that show call it about a mid-single digit decline in grocery spend for users of GLP-1 drugs. And in particular, savory snacks, things like potato chips and chocolate, et cetera, are down low double digits in terms of consumption.
Wow. So that goes to, they do it sort of as a tonnage thing at grocery stores, that kind of thing, right? Can you see it in that?
Well, I think this is mostly survey data asking consumers kind of what did you spend before, what are you spending now? And looking at across the averages, and then asking specifics around what are the categories where you're cutting back the most.
Interesting. And then one of the other massive secular trends for everything, no matter what sector it is AI and the implementation of that by companies. What are you seeing there? There's some obvious places that you would think retailers would put that to work probably right away, probably have been actually in certain ways for years, but where are you seeing that take hold in recent months or quarters?
So a lot of companies are still, I think, working through in terms of what will be their ultimate communication regarding, how AI is going to help their business. But the areas that are emerging as, being maybe at the forefront of that include efficiency and optimization of advertising. It includes employee training. So for example, at Walmart, which owns Sam's Club, they have an app called Ask Sam's, which is like a chatbot that enables employees to, wayfind through the store or even, find answers to common questions. And then there's also the big picture of even supply chain and inventory optimization. I was talking recently to O'Reilly Automotive Management, which is one of the big aftermarket auto parts retailers. And for them, what AI could mean is, as they think about their nodes of distribution, so you have mega hubs or very large hubs, you have market hubs, which carry a little bit less inventory than that, and then the stores that have inventory.
And are the hubs cities?
So the hubs, these are just distribution centers, to clarify. So we can have distribution centers that have over 100,000 SKUs in them. Then we have some that may have 50,000, and then others that might have 20,000. And for them, they're using AI to analyze the US car park, figure out which vehicles on the road are off warranty, and looking at market areas, which inventory should we have at that closest point to the end consumer, being the store, and how can we get that within a day delivered if we need to.
So they're researching the cars that drive around that area, that neighborhood, that area, and which are off warranty and which are going to need to have a new set of whatever tires put on them, and having that close by.
100%.
That is so interesting. Okay, so is that at this point visible in earnings?
Yeah, I would say this is one of those things where, again, we know what the promise of AI is, but it's one of those things where companies are still working through it. So the short answer is no.
Okay.
We need a little bit more time for that.
Really interesting. How does that work in terms of e-commerce? Some of what you described there actually is e-commerce, but when you see things shift, I think you were mentioning just off air that last January, when there weren't as many people out because it was frigid or it was bad weather or whatever, you just go home and buy it online. So it's sort of all evened out. How do some of those numbers look now? I mean, it's been eating storefront for years now,
e-commerce, continue to see growth in e-commerce. Admittedly, it did slow in terms of the year-over-year growth in January relative to December. And as you mentioned, so while we can talk about winter storms and weather this year, it was also a factor last year. We didn't get much of winter in November, December, and then we got some storms in January. So there is a comparison impact here to consider in terms of storms last year and this year. But at the same time, normally when consumers are kind of in place because there's these traffic limiting events, we do see a bit more acceleration in e-commerce sales than what we saw in this particular January, which is maybe one contra argument to say the weakness might not all be due to weather. Right. We should keep an eye out for that.
Keep an eye out for that. Yeah. With that, which sounds, baseline negative, actually, there is wage growth. There is a wealth effect that's been going on. For those that are exposed to the stock market, it's been an excellent year. People are feeling the wealth effect. Mm-hmm. How is that working into, a general optimism, and how do you square that with some of the numbers you got?
So I think, when we talk and we ask companies, about the consumer, the message we've heard is that they're resilient, but they're being choiceful. And we also know that consumers are celebrating the holidays. So one of the observations has been, consumers do come out and open their wallets during holidays. But then again, the shoulders seem to be getting, the difference between the peak and the shoulder seems to be getting a little bit steeper. And so, again, this being January, which is usually a clearance month in retail, and after the peak, it could just be a continuation of that trend, being that, hey, we've had the holiday and now consumers are going back to, being choiceful. Yeah, but we look at companies like Costco, which is exposed to the high-income consumer, and still seeing great same-store sales numbers out of that retailer. And we know that Walmart, for example, when it talks about its market share gains, would say that somewhere between 2/3 and 3/4 of those gains are coming from higher income consumers. So it's definitely been a case that those that are higher income, that have had a little bit more wage growth, that have had the impact of equity markets and seeing some stability in resale housing prices, have been spending a bit more than lower income consumers.
Really interesting. Let's go back to some of the policy features that may or may not be lifted, clarified, some certainty brought in there. One of them was a policy, I think you had mentioned immigration for sure, some discussion of the Farm Bill, but also I think stamps was also a piece of the policy that was with the DOGE clear out of government, really. Yeah,
so the SNAP program or food stamps is one that seems to have been targeted, and it was on our radar from I don't know if, as you would have followed the election debates, there was this reference to this Project 2025 document.
Yeah.
So it was mentioned in that document in terms of the expansion of benefits under that program and whether it was some place that the government could look for efficiency. So from that point in time, we had identified it as a risk. And so, I would say over the past 12 months, it's a little under $100 billion in terms of the total spend there. And about 10% of the population benefits from SNAP. So, what I've seen in the public realm thus far in terms of bills being put forward or suggestions being put forward points to something like a 10 to 15% potential reduction, over a 10-year period, but in terms of SNAP cuts. And so that could mean for those under 50,000 household income consumers, there's going to be a reduction in some of the income that they have. The interesting thing about SNAP is, it's kind of easy to track who are the retailers that are the big recipients of SNAPs, and they would be, as you would expect, probably the dollar stores and Walmart, etc. But the way I think about it is actually it's part of the overall consumer wallet. So as a consumer, if I'm using SNAP, I'm spending that tender at retailers that accept it and using my real money in other parts of the economy. So it's not a one-to-one if we think about where it shows up and where the risk might be. It might actually be a discretionary retailer that exposed to the low-income consumer that feels the impact of this, as opposed to the dollar store or Walmart that is receiving that tender. Because if you think about it, consumers are still going to have to eat, they're still going to have to buy consumables, so it might be other items that they need to cut back on if we do see a reduction in SNAP.
That's fascinating and great that you are actually keeping an eye on that. Ultimately, the other piece that you were talking about was sort of the unprocessed foods. This is where food companies, may have to rethink how they either make things or the ingredients. Is that how does that filter down into the retailers?
Well, I think
if at all?
what retailers are seeing, so the other side of this overall reduction in spend, but some retailers are talking about, hey, so we are seeing consumers seeking out a bit more fresh produce and fish and yogurt or certain dairy products, and so
They're all going on the Mediterranean diet. Yeah. Okay.
so you change your merchandising mix if you're a retailer. There's examples certainly of there's a company called Sprouts Farmers Market that that's kind of their main business, and so they've actually seen accelerating growth during this period of time as a result, I think, of this trend of consumers seeking out a little bit more better for you foods. And so, yeah, I would say today, so the retailers do have the benefit of what I talked about, their pharmacy business doing a little bit better. They can merchandise around what consumers are looking for and offer that and present that better to the consumer. I guess a worry point to think about is these companies do provide trade dollars to the retailers. They are some of the same customers that are advertising with retailers.
Right.
So the question becomes, how does their strategy evolve?
If you're potato chips
right,
or whatever.
Yeah. As the demand is going down, like, are they going to advertise more or less? Do they trade spend more or less? And so there is a connectivity there.
Yeah.
And certainly, like, when was the last time you saw an ad for broccoli, right? So there's more ad dollars on the center store part of the retail equation than there is on the fresh and meats part of it.
They have to show it dressed up a bit in a recipe or something.
Right.
They can't just show the broccoli, because no one wants to eat that. And not in my household anyway. Tell us a little bit about some broader market trends. So the idea of broadening, actually the idea of we're in a lower interest rate environment in the US and Canada too, but we're talking about the US. And the idea that it should spur those companies down the cap spectrum because they might just have a little more room to move. Does that fit with what you're following? Is it still a winner take most market? Is there room for new players essentially?
Yeah, I think the answer changes depending on if we're talking about staples retailers versus manufacturers and beauty and marketers and so on. So for the retailers, I do believe we're in a scale game here, especially as far as e-commerce growth and the interconnectivity of digital advertising to spurring the flywheel around that. But when we come over to the other side of the equation, whether it's a new protein product or food product upstart or a new beauty brand, we do see a bit of a democratization of, or lowering of barriers to entry for these companies in terms of no longer do they need a national advertising campaign. They can use social media or have an influencer kind of bring discovery of that product. No longer do they need necessarily shelf space allocation at a major retailer because of the prevalence of online retailing. And so it's a little bit easier for these companies to enter the market, and therefore if you're a large existing player in the beauty market or in the food market, there could be this kind of nibbling away of market share from these upstart brands.
That's really interesting. So would that ultimately sort of tilt the way you could look at some of these companies? Maybe not positioned specifically as a question to you, but is that something that would be shifting the way you could look at the staples?
Yeah, I think so.
It is.
Yeah,
it could come down the pike ultimately. Okay. When DeepSeek Day came, a lot of sectors had different responses. Companies had different responses. It was a shake-up in the market, and lots of people suddenly took notice of what might be cheaper. Some of the big players that you follow will have made huge investments in AI. I guess what does it mean tangibly that they could spend less on CapEx technically?
Well, I think, so big picture, so as much as we talked around the negative sentiment around staples, I guess the two watch-outs or things that could cause investors, like on a dime to change on that, would be, number one, if all of a sudden some of the prospects or optimism around AI fades, we could probably see a big rotation. So on that DeepSeek Day, if I can call it that, we did see for these companies that are trading, call it 10 to 15 times PE, a lift. So they were actually up on a day that NVIDIA and others were down. And so that's one. And then secondly, if all of a sudden the probability of recession which is very low in the US right now, starts to rise, it would again be a driver of rotation. But I think, I mean, generally because the companies I cover are going to be the ones, licensing AI or ultimately the customers of these tech companies, to the extent that prices are going down or the cost of using that tool is going down, I think it's ultimately better for the ROI for those companies.
That's so interesting. So, I mean, the idea that just a leadership change in the equity markets ultimately, could happen,
Yes.
and there's those with very high valuations that may have to move aside.
Yes.
Okay. Really interesting. What is the valuation? What are they trading at as sort of a group? Consumers.
Yeah, it's one for the time I've looked at the market, and I've been covering consumer in general for over 15 years. U.S. approaching 4 in particular here at Fidelity, and I've never seen such a wide spread in terms of, we talked last time when I was here about bifurcation and the valuations of Costco and Walmart, which have continued to actually float higher. So Walmart today, over 40 PE, Costco over 50 PE. And there are a few companies in the middle, call it like a 20, 25 times, 23, like BJ's Wholesale Club and a few others. And then there's a group that are generally in that lower camp. So whether it would be so this is 15 and below.
Okay.
So Target, some of the grocers, so conventional grocers like Kroger and Albertsons, some of the food manufacturing companies such as Campbell's and Kraft and so on. And so I think, in this idea of a rotation, you probably would, one conjecture I would have is some of these well-performing retailers have probably been, while they're not tech companies, they've probably been in a basket related to momentum. And so if we had a rotation, they may not do so well. And then these companies that have been the laggards, where PEs have been compressing towards the 10 times, would probably be beneficiaries and names to look at first on the watch list there.
That's so fascinating. So for those that are trading sort of 15 PE or below, and I know there aren't tons of them, is it a big moment for consolidation, or could they be takeout targets? Is there sort of an excitement about that?
Well, post the tech bubble, there was this period, especially in the food manufacturing space, where there was a consolidation. And so where there was 2 things that were happening in that period of time. One just being the idea of M&A and consolidation, but also we had this period of, I would call it the 3G capital era, where the theme was companies coming together and cutting costs, cutting marketing. I would say history has taught it that wasn't a great value creating exercise, and so
it was not
in terms of these companies ultimately had to, and there's still some of them are in the progress of trying to build up their advertising and marketing spend because they cut too deeply, and the result was they lost market share and volume as a consequence of that. But standing here today, leverage ratios are higher because some of these companies have actually made acquisitions during the last 3 to 4 years, and so the low PE stocks that might have in the past been candidates for M&A, I think with leverage being a bit higher, there might be fewer opportunities to do that without issuing equity or doing something more creative on the balance sheet side.
That's so interesting. So they're not necessarily, they might just have a debt load that isn't attractive to those that might want to take a look. So if you were to kind of boil it down to, it sounds like some version of a leadership change would be very interesting for the sector. And the policy uncertainty, is that what you'd like people to take away from this? That there's room for a rotation perhaps, and also some clarity.
Yeah, I think on the other side of valuation underperformance this big, one has to at least ask a question, so when is the time? And so my message today is not a no never, but just not right now.
Yeah.
And so some of the things I'd be looking for would certainly be clarity on the tariff front for one. Working through what's going to happen with the SNAP benefits, another, immigration, another. And even with some of the long fuse trends like GLP-1 still being out there, I think just getting some release valves in terms of these signposts giving us a little bit more clarity on what we should be discounting, I think will cause investors to feel better about investing in consumer staples, and certainly would be a catalyst for me to get more constructive.
Fantastic. It's great to see you, Chase. Thank you very much for taking us through the case for U.S. staples. And if anything moves, we'll make sure you're back to join us again. Thanks
Great
a lot.
to be here.